All right, so why invest in stock? And this is from an investor's perspective. First off, let's go through what is an investment. An investment is anything that you can put money into with the expectation that it will generate positive income and or preserve or increase in value. Once again, an investment is anything that you can put money into with the expectation that it will generate positive income and or preserve or increase in value. You have a lot of investment vehicles out there, a lot of investment options. Savings accounts, savings bonds, certificate of deposit, CDs, mutual funds, stock, real estate, collectibles, and we'll go more into detail about these different investments options a little bit later. Risk versus reward. The main difference between these investments is the risk and reward. Risk is the possibility that an investment will lose money or fail. Reward is the possibility that an investment will make money or succeed. And there are a couple of things that you really need to keep in mind and put this into your memory banks. When it comes to risk versus reward, the higher the risk, the higher the reward. And this simply means that the higher the possibility that you will lose money or your investment will fail. If it does not fail and it does does well, then your reward will be high. And on the flip side, the lower the risk, the lower the reward. And this means that the lower the possibility that you will lose money, if that investment does succeed, it will be a lower reward. So some examples of some low risk investments would include savings accounts, savings bonds, certificate of deposits, money market accounts. And I also have included mutual funds here. And I will discuss that later because mutual funds can be a low risk investment or a high risk investment. Um, I went to bankrate.com to see what the different interest rates that the highest interest rates that are being offered on savings accounts, and these are the figures that I got. I mean, the savings account is between 0.675 to 1% on savings bonds, which are usually issued by the government, the U.S. government, 1.1%. Certificate of deposits, 1.1%. Money market account, the highest money market account rate or interest rate that they have is 1.1%. I mean, look, it's basically if you were to put your money into a regular savings account, then your your return at the end of the year would, if we were just to take the highest percentage amount, 1%, basically you would get $1 after keeping $100 in a bank for an entire year. All right, examples of high risk investments. They include mutual funds, because like I said before, a mutual fund can be a low risk investment or a high risk investment. And I'm going to talk about mutual funds in another presentation. Um, but for right now, we're gonna continue on with this presentation here. Stock is a high risk investment. Real estate kind of depends, and the reason why I put real estate in the category as a high risk investment is because of the amount of money that you have to put into real estate in order to invest in real estate. It's not, we're not talking about $10 or $20 that you put into real estate. You're putting in a massive amount of of cash into investing in real estate, and it all depends on real estate. A lot of people invest in rental properties, and depend if your rental property is paid for in full, then the money that you get from your rent is just basically cash flow. However, if you have a mortgage on that house, then your cash flow will not be as much. So it all depends with real estate. Collectibles. A lot of people they invest in classic cars, vintage cars, antiques, baseball cards, and these actually they're very high risk, but they are very high reward. If you get your a baseball card signed by the right person, or a baseball or any type of sports memorabilia, if you get it signed by the right person, it can very, very well be worth a lot of money in the future. But it's a high risk item to invest in. So investing in stock. When people invest in stock, they're looking for two ways to get a return on their investment, okay? And those two ways is the appreciation or increase in value of the stock and dividend income. So appreciation in value. A stock appreciation or increase is the difference between the price that you paid for the stock and its current market price or value. So that basically means that if the price you paid for the shares is less than the current value, then the stock's value has appreciated or increased. And on the flip side, if the price that you pay for the shares is more than its current value, then the stock value has depreciated. And I know I put stock appreciation as the intro into this segment, but I'm trying to keep it a little bit positive. Hopefully, you're on the side of stock appreciation more times than you're on the side of stock depreciating in value. So dividend income. Um, what is a dividend? Well, based on the performance of the company and other factors, a company may decide to issue a one-time payment or a dividend to all shareholders. Basically, you, what companies do if they make a profit or they have a good year profit-wise, they sometimes decide that they're going to share the profit amongst all of the shareholders. And this payment or dividend is given on a per share basis. It's based on how many shares that you own. The dividend amount is usually a very, very small sum. Um, so let's look at this right here. Philip Morris, if you own stock in Philip Morris and it declared a 3-cent dividend to all shareholders, let's say you own 2 shares, then your total dividend payment is only 6 cents because it's a 3 cents dividend and you only have 2 shares. And if you notice, the dividend amount is very small. And so I want you to really look at that you're not going to make a lot of money with dividend income, unless you own a million shares. If you own a million shares and they pay you a 3 cents dividend, that's a lot of money. That's $30,000 right there. But if you only own 10 shares, that's really nothing. So where you're going to make your money in the stock market is in if the stock appreciates. Okay, if you are a person who's looking to make some dividend income, then you should look at more established corporations, um, like McDonald's, Walgreens, Procter and Gamble, the big corporations that's been around for hundreds of years. Those guys, they're making a consistent profit year in and year out, and they do consistently give out dividend income. Startup companies, they rarely declare dividends because startup companies, usually in the first couple of years when they're trying to get established, they're losing money initially because they haven't built up their customer base, they haven't built up their sales as of yet. However, established companies, that's totally different. There are advantages and disadvantages of owning stock. Advantages of owning stock, you can own a piece of a company. Ultimately, stock is like an asset. Some people, if you have enough stock, if your portfolio is large enough, you can use your portfolio as collateral on getting a loan because stock is an asset. Stock can appreciate in value. Stock can give you current income via dividends. Usually yields higher returns than traditional investments. Remember, higher the risk, the higher the return. Stock is a high risk investment, so it usually will give you a higher return than savings accounts, CDs, savings bonds, money market accounts. The disadvantages of owning stock is that stock can decrease in value. It can depreciate in value. Also, if the corporation goes out of business, then your stock in that company has no value. And an example of that is Enron. Once Enron closes stores and they no longer could operate, then that stock at that point is worthless. Um, Another disadvantage is that if unless you own a significant amount of shares, you don't have much input in the everyday operations of the corporation. So you don't have as much control as a person who owns 51% of the company. So you're basically, as a beginning investor, or you just starting out, you're basically placing your hopes in the management team and the employees of the corporation to do their job to make that company successful. Um, Stock is riskier than traditional investments such as savings accounts, CDs, savings bonds, money market accounts. Once again, CDs, savings bonds, money market accounts, they're lower risk investments. Um, so they have a high possibility of you getting your money back. Whereas stock, it can decrease in value. The company can go out of business. A lot of things can happen. So they're riskier than traditional investments.